Do you ever feel lost when you're looking at financial statements like the profit and loss? Well, you're probably not alone. For many founders and small business owners, untangling and making sense of things like the profit and loss can feel a little bit like learning a foreign language for the first time. But here's the thing. Failing to understand what the profit and loss is actually telling you is incredibly risky because it puts the financial health of your business at risk, and it makes it really hard to know if you're actually making progress from month to month or year to year. My name is Littlewood, and in this video, I'm going to be helping you decode the profit and loss statement. I'll be showing you why it's such a critical tool for building a financially healthy and stable business. We're also going to look at how you can use the profit and loss statement to track your success and avoid costly mistakes. Now, make sure you stick around to the end because I'm going to be sharing with you guys a free guide and resource. It's basically a cheat sheet to the profit and loss statement that will help you understand and analyze what's going on with all of these numbers. So let's start out by addressing the question of exactly what is a profit and loss statement. So a profit and loss statement is one of three financial statements, the other two being the balance sheet and the cash flow statement. But basically what we do with the profit and loss statement is we're tracking all of the incoming revenues and sales during a certain period and all of the expenses that the company is, spending in order to generate or achieve those sales. Now, a critical concept of the profit and loss is that it refers to a specific period of time. Some of the more common periods of time would be a year, a quarter, a month, but you could also create a profit and loss statement for a week, a day, or even an hour if you really wanted to. Essentially, what the profit and loss statement does is it answers a very key and critical question for any company, which is that business doing the thing that it was designed and set up to do, which is generate a profit? Another really important concept here is you need to realize that the profit and loss statement is really only focusing on the core operating activities of the business. They're really the centerpiece of this statement. So there's a lot of ways that cash can come into and out of a business. For example, you might get a grant, you might get a loan, you might get money from investors, you might be spending money on plant and equipment. Those sorts of expenses or cash flows will not be reflected on the profit and loss statement directly. What the profit and loss statement is trying to capture is the activities associated with producing and delivering to the customer your key product or service, whatever it might happen to be. So let's now talk about the overall structure of the profit and loss statement. At the very top, what you're going to see is revenue or sales. And tracking this revenue growth, either month on month or year on year, is actually really critical for understanding the business's trajectory. Revenue growth can be an indicator or signal of things like product market fit. How's the economy going? Is demand overall increasing or decreasing for this product? And it can also give us clues about things like the competitive landscape. Is someone coming in and potentially taking market share from your business? However, revenue alone doesn't obviously give us the complete picture. So the next major line item on the profit and loss statement is the gross profit line. And the way that we arrive at gross profit is to remove all of the costs associated with delivering the product or service to the customer. Now, for an e-commerce or CPG company, this is going to include all of the costs that you pay to your manufacturer or supplier. It would include all of the freight that you required to pay to get it into your warehouse. It should probably also include the storage costs in your warehouse, and then all of the costs of actually delivering that product all the way to the customer's door. So in other words, the pick and pack fee, the mailer that you ship it in, and the shipping cost itself. What you're going to get once you have removed all of those costs is gross profit. And this is basically an assessment of how efficiently is the business delivering or providing its core product or service. Needless to say, the higher the gross profit, the better off that business is likely to be. So the next major line item is a little bit kind of industry specific. You'll see this in certainly e-commerce businesses and maybe some CPG businesses, but another metric we like to calculate here is called contribution margin. And essentially what we're doing with contribution margin is removing from gross profit, we deduct all of the variable advertising costs. So these would be the costs that you're paying to advertisers like Facebook, Instagram, or Meta, Google as well. Maybe you're advertising on TikTok. And the reason that we do that is we basically kind of recognizing that part of the mechanism that makes this business work is acquiring customers, right? If we don't have that function of acquiring customers and bringing people in the door, then people aren't just magically going to stumble over your website, right? So we need to acknowledge that there is a cost to bring people into the business. And that's what we're trying to acknowledge or understand when we look at contribution margin. Again, the higher the contribution margin, the better off the business is going to be. After that, we would get down to what we call the EBITDA line. Now, EBITDA stands for earnings before interest, tax, depreciation, and amortization. And the difference between contribution margin and EBITDA is that we've removed all of the other indirect and overhead type costs. So this would include all of your software costs, all of your fixed marketing costs, all of your staff and labor costs. Maybe you've got a rent, some rent for the office and so forth, meals, travel, entertainment. There's usually a pretty big chunk of these indirect costs, right? So once you've removed all of the direct costs, which were associated with the product, and all of the indirect costs or overhead costs, then you will be at the EBITDA level. The next major line item or margin that we look at is called EBIT, which is just earnings before interest and tax. So what we've done here is remove depreciation and amortization. Now, for most e-commerce businesses, this is usually pretty small. And the reason for that is that these are typically fairly asset light businesses. So they tend not to generally own their own plant, equipment, warehouse, real estate, that sort of stuff. Most e-commerce businesses will be working with a manufacturer or supplier or a co-packer. And so what they're essentially doing there is basically renting or borrowing the facilities that are owned by some other person or company rather. Therefore, they do not really need to count or capture the depreciation charge. So it's I'm used to seeing very, very low depreciation and amortization numbers for e-com and CPG businesses. That's not always the case. Your business might have some plant and equipment, in which case this is where we would need to depreciate it. The other thing that we sometimes see here is the amortization on things like patents and IP. So if you have any intangible assets like that you've developed through R&D, for example, we would amortize them in this section as well. So the final measure that we have on the profit and loss statement is called the net income. And this is just after removing the last few expenses, which are going to be basically interest expense, interest income, and also any taxes that the business might be paying. But basically, once you've removed them, you will be down at the net income level, also known as the bottom line. So we started at the top line. We've now worked our way all the way to the bottom line. Okay, so now we've got a basic understanding of what the profit and loss actually is. The next thing I wanted to talk about is what we can actually use it for. There's a number of different uses, but the first and probably one of the most important ones is for benchmarking and comparable company analysis. You see, all of these different margins that we just finished calculating can be quoted or determined as a percentage of revenue. So for example, you might say that my contribution margin is equal to 60% of revenue, hypothetically. Now, a really useful exercise to do is compare that 60% to what other companies like you are generating, right? And you can do this at any point in the profit and loss statement that you want. What this helps you understand is, how do you compare to the other guys? Are they operating more or less efficiently than you are? So another thing that I spend a lot of time doing with the profit and loss statement as a fractional CFO working with early stage brands is we do a lot of time series and trend analysis, which is basically looking at how these different parts of the profit and loss statement or the ratios or metrics are kind of improving over time, right? Obviously, it's helpful to have costs coming down over time and things like the contribution margin and EBITDA going up over time. So it's really, really helpful when you're running these businesses to be able to establish correlations between the initiatives that you're implementing to try to improve the business and the impact that they're actually having on the numbers. Another really, really common use of the profit and loss statement is to attract and engage with capital providers, which could be lenders, investors, or maybe even acquirers of your business. So a lender of debt to your business is going to look at your profit and loss statement to try to understand what is your ability to repay them. If they give you a loan of $100,000 or $1 million, are you going to be able to pay it back? Well, the profit and loss statement is likely to be where they will look to get an answer to that question, right? Similarly, if someone is looking to buy your company, either in its entirety as an acquisition or a small part of your company as an investor, then they're going to look at the profit and loss statement to get an idea of how much the business is worth. Obviously, businesses that are generating more profit have more wealth to distribute and share, and so they're more valuable companies. So the profit and loss statement isn't just a random financial document. It's a roadmap for making smarter decisions, benchmarking, and driving long-term success in your company. So whether your goal is to increase revenue, optimize your margins, or just secure a loan, the profit and loss statement is key to building a healthy and sustainable business. So if you're ready to unlock the power of your profit and loss statement, then head down to the link below. I've got a free resource and guide that's full of actionable tips to help you optimize the financial health of your business. And while you're here, don't forget to like, subscribe, and hit that notification bell so that you can receive more of this content I'm putting out all about financial literacy and how to grow a profitable e-com or CPG business. Thanks, guys. I'll catch you next time.